Getting into the world of investing can be very confusing when you're first starting out. If you've clicked on this video, you've probably got 4 main questions on your mind. Number 1, what is investing? Number 2, what are the reasons why someone would want to invest? Number 3, what can you invest into? And finally, number 4, whether it's right for you. Well, today I'm going to be answering all of those questions in the most simplest and quickest way possible. This is the introductory video to investing I wish I had a couple of years ago before I started investing. Hey everyone, my name's Dev, welcome to the channel. I hope you're enjoying your stay so far. But before we begin, this video is for informational purposes only and is not financial advice. Obviously, as all my other videos, I'm going to put timestamps in the description down below, so make sure you skip around the video to what part you see fit. So we're going to kick it off with what happens to your money if you do nothing. Well, in simple terms, money loses its value over time. So to understand why, we're going to be taking a brief economics lesson about inflation. So inflation is described as a general rise in prices and the fall in the purchasing power of money. In other words, everything is getting more expensive over time, so you're able to buy less of it with the same amount of money. So for example, in 1990, the price of a bottle of milk was about 25 pence, or 25 cents if you will. But in 2020, the price of the same bottle of milk was about 45 pence, almost double the price. And if you had £1 in 1990, you could have bought 4 bottles of milk, right? But let's say you saved that £1 for 20 years. You would still have £1, right? The actual quantity is the same. But now you can only afford 2 bottles of milk for the same money. So our takeaway from this is that your money is losing value if you do nothing with it. So now you're probably wondering, well, how much is it losing value? So inflation varies year upon year, and it depends upon what country you're in and how your economy is managed by your country. So for example, in the UK and the USA, inflation tends to be around 1.5 to about 2.5% every year. So in other words, your money is losing value by 1.5% to 2.5% every year, which is clearly not a good thing. Now you're probably going to argue, but Devify, my bank gives me interest on my money. That's true, but if you actually have a look at how much interest you get, most banks in the UK only give you an interest rate of, below 1%. Hell, you'd be lucky to get that. I mean, HSBC gives me about a solid 0.01%. So now you know that your money is losing value every year. And you know that putting your money into a general bank account isn't doing you any good. So now the question on your mind is not only how can I stop losing money, but also how can you make more money while you're at it? And this is where you might have heard the phrase, make your money work for you. So this is where the idea of an investment is born. An investment is to allocate money into something with the expectation of a positive return in the future. Something that's going to bring you money into your pocket, basically. So remember, to be able to make more money, you need to be generating a return that is more than inflation, so more than the 2.5% every year. And if you're making any less than this, your money is still losing value. So if you're earning, let's say 1% interest a year, and you had £100 to start with, right? Now you have £101 after a year. You've actually gained money, but the value is still going down. So next up, I'm going to go over what happens when you invest over a long period of time. There's a cool little effect known as compounding. So to visualize what compounding is, I'll start with an example. So let's say you start off with £100 into an investment, okay? And you're getting back from this investment 10% every year. So your money is going to be earning, after a year, you're going to be having £110. After 2 years, you'll get 10% of that. So your £110 now becomes 121. And after 3 years, now your money is going to be £133.10. So if you notice, this increase every year isn't the same amount. In the first year, it increased by 10, then it increased by 11, and then by 12.1. So it isn't a straight line. It's actually slowly curving up and getting more and more every year. And eventually you get to this stage where growth is going to be exponential, where it goes all the way up like that. Or the opposite, because this is reflected by the camera. But yeah, so that's why it's really crucial that you start investing as early as possible, because waiting a few years will mean that this compounding effect will happen much later on in your life. Simple, right? Okay, so now you know what's going to happen, if you invest. But there isn't actually only one type of investment. There's actually quite a few different categories, and I'm going to be referring to them as asset classes. An asset class is a group of investments that behave in a similar way to each other. So that means that each asset class will obviously be quite different from each other, right? So they're going to be performing independently and not influence each other at all. So just because one asset class is doing really well doesn't necessarily mean that another class is also doing well. It might be doing bad, it might be doing well. It doesn't affect each other. And That's why a lot of people recommend that you diversify into each of these asset classes. In other words, put in a certain amount of money in all of them just to be the most risk averse, the most safest, because just in case one drops, the other might do well. Now I'm going to briefly explain the 6 main types of asset classes. So the first asset class is the like button, and investing in this by smashing it will yield by far the most returns, so make sure you go do that. Okay, seriously though, but the first actual asset class I'm going to say is cash or cash equivalents, and these are things such as a current account or a high interest savings account. Now, high interest savings accounts, such as a Help to Buy ISA or a Lifetime ISA, they're much better than a regular savings account as they offer higher interest rates. But they still tend to be lower than inflation, so it's not really the ideal place to put your money. Plus, they sometimes come with restrictions. So for example, in a Help to Buy ISA, it only allows you to put in £200 a month, which can seem a lot when you start off, but when you're earning money, it's not actually a huge amount, 200 a month. So the next asset class that we're going to look into is stocks and shares, and this is called equity, and this is where you buy ownership into a business. And investing into stocks and shares tends to be a bit more risky than most of the other asset classes, but I do have a video coming soon on how to do it with as little risk as possible, so make sure you go stay tuned for that. Investing in stocks and shares tends to be quite quick, it's easy, and you don't really need a lot of money to get started. So if you're a beginner especially, I would recommend investing in this asset class, but obviously everyone invests in stocks and shares, so it's for everyone. The third asset class is fixed income. So fixed income is essentially when you lend someone your money and they give you an interest income back to you. An example of this can be either bonds or fixed deposits. Now in general, fixed income asset classes tend to be fairly low risk, but as a consequence, the money that you get back isn't really the best either. The next asset class is real estate, and this is about the ownership of physical space and could include things like buying a house and putting it on rent, or even selling it later on. So real estate tends to be quite, relatively low risk, and it can give you quite a good return on the money that you invest. But the con to this is you need a much larger amount of money to get started, and it can also be a bit more time consuming to manage. Next up is commodities. So commodities is about owning certain goods, such as gold or silver. These tend to be fairly stable and lower risk, but the return on investment is also a bit lower. So it's not always the best to get into. Finally, the last big asset class I would say is cryptocurrency. Now this one is a bit debatable about whether it can be defined as its own asset class or not, but I'm going to categorize it separately because it's very different and it's quite new as well. So cryptocurrency includes things such as Bitcoin, Ethereum, or even Dogecoin, Doge to the moon, if you know. But investing in crypto is, it's a whole different ball game, and that's for another video. But crypto, I think by far is the most riskiest out of all these asset classes, but it does offer the most return as well. So investing in that is up to you. Okay, so now you know what the reasons are for investing, and you know what you could be investing into. But now you probably have 2 questions that are left on your mind. Is it right for you? And if it is, then which of these asset classes should you be putting your money into? And so to answer the first question, whether it's right for you, I'm going to ask you 3 questions. Number 1, do you have any leftover cash at the end of each month that just sits in the bank account and just gathers negligible interest? Number 2, do you have any money that you could be saving but you're just spending it unnecessarily? And number 3, probably the most important, have you saved up about 6 months of an emergency fund? This is a set of money that in your bank account that you can use in case of any emergency, some kind of unexpected expenses comes up, you lose your job, stuff like that. And you should be able to pay off your rent and your living expenses and not have to worry. If you answered yes to any of those questions, then I would personally say yes, you should be investing your money. But where do you invest your money? So to answer this next question, it is dependent on the time frame of your goals. And the reason the time frame is important is because investments don't always, they're not always smooth. They don't just go up constantly. There are times where the market goes up and there's times where the market is down for a bit. To put this into perspective, we're going to take a look at something called the S&P 500. So in simple terms, this is a group of the top 500 companies in the USA, and we can see how they've performed over time. Since this group, or index as they call it, was introduced in the 1900s, its performance has gone up and it's gone down. Especially gone down during 2000, during the dot-com crash, during 2008 with the Great Recession, and during 2020 when the pandemic hit. But overall, the value of this index has risen over time. Now, if you bought in 2007 and then took out the money in 2008 after the crash, obviously you would have lost a lot of money. But if you had waited and not sold your assets, your money would have gone up eventually. It might have taken a few years to, as they say, ride out these waves. But that's why it's important to know when you plan on taking out this money and using it. Are you planning to take it in the next few years, next 5 years, 10 years, or are you saving up for even later than that? So this determines how much risk you're able to handle and can help you answer where to put your money. So if your goals are relatively short term, so a couple of years, then it's probably not worth investing into riskier asset classes in case they go down when you want to take out the money and buy your house or your car. It's not worth it, right? I mean, it could go up, but it's just not worth the risk. So now you want to invest into safer places such as high interest savings accounts, bonds, or even fixed deposits. If your goals are medium term, so let's say 5 to 10 years, then you can start to look into things such as commodities, stocks and shares, and real estate. And if your goals are, let's say, about 10-15 years and over, then you should probably be putting your money into mostly stocks and shares and real estate, and perhaps even cryptocurrency if you believe in it. So hopefully I was able to introduce you gently into the world of investing. Keep in mind, this is obviously my opinion, it wasn't financial advice, and you're welcome to sort of spend your money however you like. Now, I'm not going to tell you how to live your life, obviously, but if you are interested in this kind of content, then I will have more coming much soon. So make sure you take care. I've been Devify, and I'm out.